current assets. Actually, inventory and store space and loose tools are somehow different from each other. Inventory are for a manufacturing company. Inventory can be of three types. Like manufacturing company first acquire the raw material, then they inject that raw material into their different departments for manufacturing, and when they add that material into the system, so they took longer period of time to convert into the finished good. So that raw material convert if into the work in process of that department. So at we have to calculate the balance sheet at any point of time, at any time. So definitely work in process is the amount of the inventory, which inventory cost which has been installed in different departments at a semi-finished basis. So if the goods are semi-finished, so definitely it will cover up in the work in process section. If the goods are converted into the finished good, and it finished good, so definitely work in process will be nil, and finished good will be have some cost of inventory if the company has completed all the manufacturing process of that finished good they have covered up all the manufacturing process for to prepare the any inventory. Store space and loose tools are those tools which are like a screwdriver, las, and whatever type this type of simple screwdriver, screws, nut bolts type inventories are actually called as store space and loose tools. These are not directly related to the product of the company, but it is called as inventory of the company. And whenever it is used, it is consumed, and it is that current assets convert into the cost of sale. That some cost of sales and some store space and loose tool convert into the operating expenses of the factory. Right. Now we are, if we talk about the trade receivables, how these are created. Actually, accrual basis of accounting and cash basis of accounting difference is simple. Whenever you have to sales on credit basis, you have to record the transaction at very next time. So the entry would be like receivable debit and sales credit, and whenever that amount is received in the by the company in future date, so that amount, that recording would be like receivable credit and bank debit. This is how that works for the trade receivable. And if we talk about the short-term investment is like if the company has deposit their invest amount, extra amount in the bank treasury bills and term deposit certificates and special savings certificates of uh, the state bank of any company, yeah, state bank of any country. So that investment, that short-term investment is called is mentioned in the current assets because it is converted into the cash into the bank balance in a period of 1 year. So it is called a short-term investment. Similarly, prepaid expenses, if we talk about prepaid expenses, are those expenses which we pay in advance against some expenses which would be incurred in the future. A prepaid expenses is the best example of insurance expense. Whenever any company take the insurance policy from the insurance company, so they in start they pay the whole amount for the year or for the period. They initially they pay for the 12-month insurance to the that company, and that time they record the entry as prepaid insurance debit and bank credit. And thereafter whenever that insurance is expired, they record the insurance expense debit and bank insurance expense debit and prepaid insurance credit. And thereafter, after the closing of the year, after the closing of this insurance period, that prepaid that prepaid account is deteriorated to zero value. Similarly, tax due from government. If the any amount is due from the government, it is shown as current assets, which can be converted, which can be received in a near future by the government. So it is also come up in the section current assets. Last one is security deposit receivable. If the company has deposited some security against some taking some services, taking some sort of the benefit from other companies, so they deposit some amount of money into the next organization. So that is also a receivable of the company, and is also covered in the current asset section. And if we talk about now the non-current assets can be broadly classified into the two categories, that is tangible and intangible. Like tangible assets are of the company as property, plant and equipment, vehicles, furniture and fixture, computer and accessories, and office and equipment. These all assets are acquired to run the business, to operate the business, and definitely have to acquire some land or rented premises to install the plant and machinery, to acquire some vehicles to transport the sales inventory, and as well as to acquire the company has to acquire some furniture and cabinets and fixtures, tables, so to have some business environment in the company. As well as they have to acquire the computer accessories and office equipment like ACs, fan, and chairs, whatever that is. Also, office equipment normally covers the electronic equipment, like, and furniture fixtures are, I have told you earlier. So these are all tangible assets which we can touch those assets, and that is available in the tangible form. The non-tangible, if we talk about the non-tangible and intangible assets, that are the assets which are acquired for the purpose of running the business, but that the nature is actually intangible, like software acquired by the company that is being used for longer periods, for more than 5 years, more than 10 years, more than 15 years. That assets are also classified as intangible assets that can never be touched easily, but not that can never be touched. But software, goodwill, and copyrights and trademarks are the amount the company invests on these things to run the business and to grow financially in all sort of. If we so the next slide, if we talk about, we have covered the current assets and non-current assets section. What are the current and the non-current assets? Now we some people classify assets into the further classification, but it is now not the practically bounding of the company to classify in all these segments, but it can also be help for the company if they maintain the data in this form, like if they classify assets in the physical form, in the usage form, in the conversion form. In If we talk about the physical asset classification, like tangible asset and intangible asset, as we talked just, and in the usage form, that are operating assets and non-operating assets, cash, inventory, building and machinery. Non-operating assets are short-term investment and back-end land interest income. This kind of the usage as based assets can also be classified. And the conversion based assets, fixed assets and current assets, which have we have actually talk about. The fixed assets are those which are tangibly available, and which can we can touch, and as well as, but the current assets are those which I have earlier told, that cash, inventory, prepaid expenses. So asset can be classified in many other categories, but the broadly I have told you that is practically being applicable all over the world are current assets and non-current assets based classification. So now we talk about the liability category. Liability category is broadly classified into the current liability and non-current liability, as I earlier told. Current liabilities are actually the trade creditors payable, salaries payable sort of transaction, accrual liabilities, utility payables, short-term liability, advances received, bank short-term finance, dividend payable, current portion of the long-term liability, tax due from government. Actually, current liability, as I have earlier told, that it is belong to the 1 year. If company has to pay that obligation within a period of 1 year, so those liabilities can be in any form. Like salaries, company has to pay within a month after the closing of the 1 month, and utilities like electricity, gas, and this sort of communication expenses, like these all have company has to pay within a close of the 1 month. So that is covered in the current liability. Advances received from any customer, like if the customer has paid in advance to the company in the form of advance money to may prepare some goods for the customer, so definitely that amount is also called as the liability for the company. If they don't prepare the goods to the for the customer, so definitely that amount that has been received by the company will be classified as advance received from the customer. And the short-term liabilities are actually those liabilities which company has to pay within a period of 1 year to the vendor, to the bank, and this sort of. Dividend payable, the company has to pay the dividend to their shareholders at the close of the period. But the dividend, if the dividend is not paid at the close of the period, definitely that amount is classified as the dividend payable account. And if the company has to pay something to the government as a liability, like sale tax, value added tax liability to the government, and the income tax liability to the government, property tax liability to the government, and other taxes that if the company has to pay, so definitely they are covered under tax due to government, and it is a current liability basis. And if we talk about the bank short-term finance payable, bank actually the short-term finance company acquire with the intention to improve their working capital requirement for shorter period of time. So they acquire the short-term finance from the bank, and the company acquired that amount from the bank, and bank has to give and deposit almost 10 million or 100 million for basis on the assets and liabilities and financial position of the company. So banks give deposit money in the account of the company. Bank actually gives some loan facility to the company for a shorter period of time. That loan amount is actually has to pay in a near future. There are there are 2 to 3 types of the short-term finance. Like bank has sometimes bank gives the whole amount of money. Like if they apply a company apply for amount of 100 million, so in one shot, bank give 100 million to the into the deposit into the bank, and create the liability and create the receivable from the company. And in company books, company has to record the liability to the bank. Now that liability can be that liability is still exists, and that amount of money can be used in any operations of the business. This is called the one shot loan received from the bank. But short term finance is like bank has given the facility if the current account or the company bank account is going negative, and they have issued so many checks and their balances are not available in the account. So that negative balance is being charged as an interest of somehow basis whatever is written in the facility, short term facility. That facility shows the interest, and that amount of that interest rate is applied to the negative balance or at any closing of each day. And each day closing balance is multiplied by the interest rate, and that amount of interest has to pay to the by the company to the bank at the close of the quarter, at the close of the month, and whatever suits to the company. So the whole these are the current liabilities which we have talked about. And trade creditor payables are the similar which we have talked about, that whatever the routine transaction of purchasing, inventory purchasing have been done by the company within a period of 1 year are classified that liability into the trade creditor payables section. And accrual liability is like company has to record some expenses based on the basis of the matching principle, actually record the expenses in the relevant month. Sometimes expenses are not recorded in the current month and they have to pay in the future month. So company has to record those relevant expenses which are necessarily required to mention in that period as it is belongs to. Like if the company is paying the electricity bill of the June in the month of the August. So they have to record expense debit and payable credit. If they don't do this, so expense would not be recorded in the relevant month of the financial. So profit and loss will not show the expenses of that June period. So that accrual liability are all covered into the current liability. So if we talk about the non-current liability that are belongs to the more than 1 year liability, that long-term loan, that is long-term loan payable, post-employment benefit payable, deferred tax liabilities and lease liabilities which are belongs to the payable obligation to pay which are in excess of 1 year is covered under the non-current liability. So these two distinctions have been created just to make sure the users of the financial statement, the whatever whoever is reviewing the financial statement, who is reviewing the balance sheet position and profit and loss position, so liability section and all the sections are being audited by the auditors. So these are the basic categories which have been defined in the international accounting standards to bifurcate and record in a proper manner in the financial statement, so that the user can easily read what are the current liabilities, how they can match their current assets with the current liabilities, how they can pay, company can pay that amount within a period of 1 year with that, and they have the ability to pay or not in the near future. So if we talk about now the what is an equity, we have talked about balance sheet, two items, assets and liabilities. Now the third one is equity. Equity is actually the capital that is being invested by the owners of the company. In a private limited company or in a individual based company, the whole capital is belongs to the directors of the company. But in case of the listed company of the stock exchange, in that case, the shareholders which are the subscribers of that company shares are actually the members of the company. So paid up and that amount that is being paid up, that is being called as paid up capital of the company, that has been paid up capital is actually the amount that is being subscribed by the shareholders, and that amount has some value, and that is being used in the bank financial position as the initial entry, or that is bank debit and paid up capital credit. So that whole amount of shareholder shares is converted into the is deposited into the bank, and then bank for that bank deposit can be used to acquire the asset, to do some sales, and to have some expenses, to incur some expenses. That cash is being used for the business purposes. So there we have talked about two sides of the equity paid up capital, that is for person and individual, and paid up capital for stock exchange listed company and shareholder equity. Third one is retained earning. Retained earning is also covered in the equity section. Actually, what is being called as retained earning? Actually, the if I have talked about the profit and loss in my earlier, there are two main segments of the trial balance. One is the balance sheet item, and one is the profit and loss item. So the profit and loss item are the sales and expenses, and the difference between the sales and expenses are routed and the difference of sales and expenses goes into the retained earning of the company of the in the balance sheet section. And after closing of the financial year, like if someone company has the financial year which is from July 2023 to June 2030 2024, if they have the financial year closing is July to June, so at the end of the 30 June 2024, they have to uh, close all the sales balances, and to have closed the all expense based account. And to close means the difference between the sales and expenses are gone into the retained earning account, and those sales account are credited and expenses account are basically expenses account are in general way debited. But at the closing of the financial year, these entries are reversed by the accounting software, and all those accountings or all those ledgers are appeared as zero balance in the next financial year, so they can record those financial year data in a starting manner in a way with a balance of zero balance. uh, so basically, profit and loss based accounts are for the certain period of time, and after that they closed, and the difference between the sales and expenses goes into the retained earning of the retained earning, that is the equity side of the balance sheet. And profit and loss sides profit and loss sides which is completely vanished from the trial balance. With respect to the balances, they vanished at the close of the financial year, and all those balances of sales and expenses are jumped into the retained earning balance. Similarly, now we are talking about the equity fourth section, that is if the company owners are um, withdrawing some cash, withdrawing some bank money, bank deposit amount from the business. So definitely here they have to repay to the company to maintain the capital of the company. So some for they can take for the short time period, so that amount, that entry can be recorded as a drawing entry, the withdrawal by the owners. So that is the simple entry is being made at that moment of time. That is the drawing debit and the bank credit. But drawing itself shows the what who is the owner of the company and who is taking that amount. So drawing is based on the individual account. If the company has seven directors and one director is drawing his amount of capital from the company, so drawing ABC name account debit and bank credit. This account entry has been made in the systems. And the fifth one is equity. If the fifth we talk about the reserves, the reserves are the actually the amount that has been reserved, that has been fixed for some special purpose by the company, that is not being used for the working capital to acquire some assets and whatever. This has been reserved for some future needs. So that reserves are actually in equity side, that is called as reserve, and in asset side some assets or some amount of investment has been blocked for the purposes of the reserves. So that is all from my side and for the balance sheet level. And if we talk about the revenue type side, what is called the revenue, and what are the types of the revenues. Actually, sales categories are in the company, like company sales are from the local side. They do local sales, they do the export sales, they actually do the scrap sales of the company. So these three type of sales based on the if the company is the manufacturing company, so they do these type of sales, inventory based sales, supplies. So they are broadly classified revenue broadly classified into supplies based sales and services revenue based sales. So supplies base, as I earlier told, that is local sale, export sales, and scrap sales. Similarly, the service revenue, if the company is providing both services, like they are producing, they are manufacturing something, and they are selling, and as well as they are providing services. This is the best example is like the Honda company. The Honda company and the Toyota company is preparing the cars for the customers, as well as they are providing after sales services like repairing services, like cleaning services they provide. So that amount of revenue covers under the service revenue, and the supplies and inventory sale, so sales are actually the car and vehicle type of sales of the company. So services revenue can be categorized into the information IT based services. Some provide services like this. Some provide transport services, delivery services, some commission based agent services are classified into the service revenue. And financial advisory, some companies are actually providing the financial advisory whenever the company is being, some companies are merging, companies are amalgamating, some companies are acquiring, some companies are liquidating, and some companies are converting their private company to the listed company. Some companies are converting their listed company to the private company by buyback share. So they all have to need some financial advisory services from the uh, reputable advisor. So they go to that financial advisors to have some services for the proper closure, proper acquisition. So those financial advisory services, type of those who provide the financial advisory services, these income are called as service revenue. Similarly, consultancy revenue, consultancy based services, and repairing services. So there are two basic categories which I have told, that supplies based revenue and services based revenue. Now we are talking about the expense category. Expenses are broadly can be classified into three types of expenses of the company. One is factory expenses, number two is operating expense, and number three is non-operating expense. Factory based expenses are actually gone into the manufacturing cost, and that manufacturing cost ultimately goes into the cost of sale of the company. So these factory expenses and cost of sales are covered from the sales revenue to arrive at the gross profit. In simple words, if I talk about all the factory expenses are recorded in the manufacturing expense. Manufacturing expense can be in the form of the two types: material expenses, raw material are in material based, and supplies based expenses. Whatever the raw material has been consumed in the company, and whatever the finished good in the form of the they have acquired finished good, and then they are trading like. So that all factory expenses which are manufacturing expense related are like a factory salaries expense, factory rent expense, factory insurance expense, factory utility expense, factory repair maintenance expense, and factory asset depreciation expense. That these are all factory related expenses. Okay, so these all expenses are covered into the factory expenses. And factory expenses, as I have already told, that is any manufacturing expense of the company is basically broader classified into the three categories, that is material, labor, and overhead. So these all factory expenses are covered into the overheads of the manufacturing expense. Further one is the labor expense to convert the product from the raw material to the finished good. That is called as direct labor expense, which is directly attributable to producing that product and the raw material as well. Then next we will talk about the operating expense. Operating expense are actually those expenses which are directly related to the operation directly not, but they are actually to operate the business. They are not actually directly expenses are covered into the factory expenses, but those expenses which are used in the manufacturing expense is called as directly attributable, like direct material and direct labor, and other indirect material and other manufacturing expense are covered in the manufacturing expense. But the operating expense, if we talk about the operating expense, to operate the business, to run the business of the company has to incur two type of basic expenses, two broad heads, like they have to pay the salary, they have to acquire the rent of the office premises where the administrative staff is sitting, and the selling and distribution expense. So these two broad categories are classified as operating expense: administrative expense and selling and distribution expense. If we talk about the administrative expense, salaries, office supplies, and rent and electricity are covered into the administrative expenses, while the selling and distribution, the sales expenses, are called as selling expense. Whatever amount has been injected to do the sales are traveling expense by road, by sea, by air, courier expenses, commission expenses to acquire the sales, and as well as vehicle repairs. Now, all these are covered under the operating expense. Now we will talk about the non-operating expenses. Non-operating expenses are not directly related to the operation, but they are really helpful for the business growth. Like a company has acquired the short-term finance, and short-term finance for do the short-term finance, they have to incur. Bank incurred some bank imposed some expenses. They have initially talked to the company in the facility letter that this amount of interest you have to pay in the given certain period of time, as the loan has been taken by the company. So definitely markup expense are the expense which are actually the non-operating expense. Rest one is the principal amount of the amount of received is not an expense. If the bank has given the loan to the company, 100 million dollar, and that $100 million is the principal amount of the to the company, and that 100 million, on that $100 million, company has to return back in a certain period of time. That 100 million is the liability of the company which can be paid. But on that 100 million, if the company is incurring the 10 million as a markup expense, so that expense is called as non-operating expense, and which is covered in the profit and loss. And it is same as now we can talk about the loss on disposal of the asset. If the company assets are being sold on less than the market, less than the book value, so that loss has been required to be recorded in the financial statement in the expense section. Similarly, legal expenses and lawsuit expenses, which are incurred to basically to do the compliance level work, like the company have some cases in the high court section. So to do that, to do to resolve that cases, company has to acquire some lawyer, and these lawyers and legal cases fees are covered into the non-operating expenses. Similarly, foreign currency exchange losses, if the company has uh, acquired, if the company is selling in the for the future, selling in the future, like they have a contract for a longer period of 6 months from the customer abroad. They have to do export sales, and at export sales, at in export sale basis, the foreign customer normally pays when the goods are received at the foreign destination, and at that moment of time, the foreign exchange losses can be occurred, like if you have a contract the say export sale on a 6 month previously basis. So the rate was somehow 300 pak rupees, and after 6 months, that 300 dropped to the dropped to the 250 as per the dollar. So that the amount of the difference between the initially agreed initial level, at that level if they acquire, and when they receive the amount, so these difference between the currency movement has been recorded as an expense, foreign exchange currency expense, and as an expense, because if that moment of time they realize the sale, so they got the full amount. But due to the late submission, due to the late inventory uh, sold, and due to the movement upward downward shipment of the currency, so those expenses, foreign currency expenses, are recorded in the profit and loss side. And now, as we talk about, there are two standards which we have to follow in future to record the transactions. uh, Previously, actually, the in 19 if we talk about the international accounting standards, international there are two standards basically, which have been followed all over the world: international accounting standards and international financial reporting standards. International accounting standards were earlier prepared by the all over the consensus of the countries, the country's finance ministers and lawmakers. So they, based on that consensus, international accounting standards were prepared at at that time. But later on, after the inception of some reporting standards has been changed. Accounting is there. Accounting has none of change. Accounting is simple: asset, liabilities, equity, expense, and sales recording. Accounting is same, but now the standards are coming for the reporting level. And that reporting level, if we talk about why they have changed their standards from accounting standard to the IFRS, basically, if I am coming that to that slide, International Accounting Standard Board, which was formed in 1973 by the in America. It has been in British, US consensus, as well as the British consensus. This was created International Accounting Standard Committee. It was formed in 1973, issued various accounting standards called as IAS, and that IAS gone around 1 to 1, 2, 3, 4, and so on to almost 41. And then after that IAS have been stopped, and now accounting is almost completed by the accounting side. But now the reporting standards are coming. So later on, IASB was founded on April 1st, 2001. International Accounting Standard Board's code were created, were formed, and that IASB is now liable and now responsible to create some financial reporting standards all over the world. That IASB is responsible for developing IFRS, which is called as IFRS. So these are the basic difference between the IASB and IAS and IFRS. So we have to, this is not that much difficult to know that international accounting standards are very simple, but international financial reporting standards are somehow tricky. To know there, if you know the basic accounting structure, so definitely you will not have the problem to get some knowledge, that some do some transaction for as per the IAS and IFRS. So I hope you have enjoyed this my presentation, and we will inshallah cover up the international accounting standards in detail, how many international accounting standards